And salutations. Nice to have you guys here. Rob, I'm not sure about the averaging, to be honest with you. I've seen it where it happens and I've seen it where it doesn't. I don't know what the difference is or what creates it. I really don't. I wish I had a better answer for you, man. Um, Good morning, guys. It is 8:58 a.m. on this beautiful 11th day of November. Thank you, Ron. Guys, good to see you. Good to have you back in here. Hope everybody's doing great. Hope you had an awesome weekend. Did something fun, or at least something that you could have gotten in trouble for, right? We're going to get into it. We're going to do what we do. Brown noser. Guys, every morning, forexfactory.com/calendar. There's nothing worse than getting into a position and then having somebody with really deep pockets push it the other way because they reacted to news. So each and every morning I go to the Forex Factory and I look for high impact and medium impact news, guys. Today, Monday, November 11th, let me start with Happy Veterans Day for those of you that serve. Thank you for that. Josh, I see you. There's no news. No news going on today, so we're not worried about it. Not worried about that big emotional reaction. We're just going to watch the market, look for our patterns. There's really none until Wednesday. Everything that I talk about, guys, is going to come from the Nexgen page. Hey, what's up, Jonathan? It's good to see you back in here, man. I try to remind you guys that there's no secrets with Nexgen. We're not a holdout and withhold information kind of firm here. I'm going to give you, by the end of this classroom, everything that you need. Everything that you need to be successful with the software. We're going to do it systematically. We're going to do it in a foundational approach, guys. And the goal is to get you good at one thing. Get solid at one thing. Get it so that this one thing is second nature. And then once it is, you're going to see the other things, guys. And that one thing is what we call the high probability trend trade. Straight from the glossary of common terms, a high probability trade is defined when each indicator on every chart agrees for the rules of the trade, guys. This is the best of the best. This is when triggers are their strongest, when there's no termination conditions, guys. There's nothing between you and your target. I start with this one every day for a couple of reasons. The first reason is that this is a trade that typically wins 70 to 80% of the time when you follow your rules. That's pretty outstanding. Good morning, Luciano. Good to see you. When you win that much, you begin to believe in your rules. You begin to believe in these patterns. You begin to respect them. Hey, Izzy, nice to have you. And you find yourself waiting for them because that success creates confidence. But the most important thing that this is going to do for you, learning this trade first, this high probability trend trade first, is it's going to teach you to read your indicators. Reading your indicators. That's just a way of saying you're reading your charts, guys. You're looking at your charts and you're saying, hey, this is what's going on. This is what I see. This is what my indicators are telling me. And chart reading is about 90% of your day. About 90% of the time, you are going to be staring at these charts and you're going to be waiting for advantages, guys. And that's tough. And I love Rob said it last week. He's like, my blue collar brain doesn't do well doing nothing. And you've really got to recalibrate. If you're like Rob or myself, same thing. I'm a keep busy kind of person. And I've had to teach myself that it's okay to do nothing. And you'll learn the same thing. And again, that goes back to as you begin to trust these patterns and trust these rules. That 90% is waiting for advantages to come into play. 10% will be actually trading, getting into the market, doing what you do, guys. But once you understand how to read your charts, you're going to understand a couple key concepts. You'll understand where the market is likely to continue. This continuation point initially is going to be your entry for the highest probability trend trade. You're going to be able to recognize where the market is likely to go. This is going to help you make good decisions on where you're going to be taking profits. And you'll understand where the market is likely to stop. And these likely to stop areas are what we call termination conditions, guys. And likely to stop areas can just 100% halt the forward progress of the market. It can create big, ugly bounces. So we're going to focus on becoming chart readers first. I want you guys to be very, very adamant that you want to be able to recognize momentum and a clear path. These are the first two rules for the high probability trend trade. Guys, there's only 3 rules for the high probability trend trade. The first rule is strong trigger lines, and strong trigger lines create momentum. Momentum can push the market in the direction of the trend. It's kind of a nice advantage to have. A clear path comes from none of those likely to stop areas in your way, guys. No termination conditions present, making sure that you have room to your targets. Once you can identify momentum in a clear path, guys, you've laid the groundwork. Once you understand when the market is pushing hard and there's nothing in the way, you have everything you need to create a very consistent, a very profitable business plan, trading plan. Your third rule is specific to the high probability trend trade. Guys, this is just going to pinpoint that likely to continue area. This becomes your entry for the highest probability trend trade. And we do these 3 rules. We recognize these 3 rules on only 2 charts. And I'm putting my little laser pointer on your large chart. The most current bar, the bar that's going up and down, that price action, guys. The large chart, and more specifically, the first bar, the most current bar on the large chart will define the direction, the momentum, and the areas in the market, guys. The first bar in the background color is going to tell you should be looking for rules to be met up or down. And then when you start looking that direction, the large chart is going to tell you if you have the momentum pushing that market. And then if you do have that momentum, the large chart's going to help you identify any areas that may be problematic, guys. 2/3 of your advantages happen on the large chart. And I'm going to say it again. Once you understand momentum and clear path, you will find your way. You will find other ways beyond the high probability trend trade to capitalize on what your indicators are telling you. Once these rules are true, and guys, really only when these rules are true, go to your small chart. Your small chart is a refinement chart. Large chart's a broad stroke of a brush. The small chart will refine it. Inside of this 1 bar on a large chart, you're going to see 20 to 30 bars on a small chart, and it's the exact same market, the exact same price. It's literally just an X-ray of that 1 bar, and you're going to use that X-ray to pinpoint precisely where the market is most likely to continue, and this will become your entry. That's where rule number 3 comes in. So the large chart leads the way. The large chart tells you that it's time to look for an entry. The large chart defines the direction in the market, the momentum, the areas, and the large chart, I want you to think of it as the large crowd, the people with more money and influence than you. These are the people that establish trends, that create momentum. These are the same people that react at those key areas. So your path of least resistance, guys, trade with the large chart, trade with the large crowd. Go with the flow. Your small chart is kind of this representation of a small crowd. And the small crowd loves to fight, and they've got money to put up a pretty good fight, guys. And they can create retracements or pullbacks that go against everything that the large crowd wants. But these guys typically fail 70 to 80% of the time. And if they fail 70 to 80% of the time, guys, your rule number 3 is going to put you into the market right at their most likely failure point, which means that you have the potential to win 70 to 80% of the time by simply going with the large crowd and pinpointing where the small crowd is most likely to fail. That's what we're going to do for the first hour, is we're going to talk about the trigger line and the Fibonacci rules for when it's okay to trade. Guys, you're going to simulate, practice, get out there, try and do this stuff. But the first step in becoming a confident trader ASAP, guys, it revolves around you posting your pictures in the room. Every time you take a trade, guys, go back to those 3 rules, those 3 advantages: momentum, path, and entry. Show me that on your chart. Tell me what you did. And every time you post in the room, it's like a private session with me. We're going to look at your charts. We're going to talk about what you did. We're going to see what you saw. And if you maybe saw something wrong, or maybe there was a way to preserve some equity through better stops, maybe there was a way to risk less through better entries, we'll talk about that on every chart posted in this room. We're going to simplify. We're really just going to focus on the high probability trend trade, and that will open the door for what we call medium probability trades. It's going to set you up to be able to take momentum trades. You're going to find your way into high volume area trades. Guys, there's so many opportunities once you understand the very basics, but we're going to keep it very focused on that high probability trend trade, guys, and you've got to know what looks you're going to commit to. The looks you're going to commit to is just a pattern. The market has a memory, guys, and these patterns that we're studying, this pattern that we're using for entry is a pattern that repeats itself on every market, every day, guys. And this pattern has been proven to win more than it loses. So you've got to know what that pattern looks like. And you've got to learn the looks so that they become easy. And that's where the second piece of the puzzle comes in. How to get to where you want to be ASAP, guys. Take your pictures, post them in the room. Let's have conversations about all of them. And then post those pictures into a spreadsheet as well. Nexgen gives you the spreadsheet when you download the software. It is in your Nexgen Study Picks folder. I share mine every day. It's a constant changing document. But the first tab is just a trade journal, guys. That's all it is. What am I doing, right? I took 2 trades yesterday. I won one, I lost one, and I got feedback in class. So this morning when I woke up, I looked at those 2 trades and I asked myself, what worked? What was the recipe for success on those trades that I took yesterday? And then more importantly, what didn't work? What are the things that I need to avoid today? Those patterns, those losses of advantages that are stealing my good time. Guys, if you do this every morning, if you go back and study that first tab and ask yourself these questions, what makes you feel relaxed? What gets you wound up a little bit? Getting nervous, moving stops, moving targets, guys. This little study each morning is going to set you up for the day, and it's going to accelerate the learning. There is links on how to post into the spreadsheet, guys, but of course, if you need help, ask in the room. That's what the room is for. And then I'm going to share this one. This is the most important thing I believe anybody can do, is annotate your charts, guys. Write on your charts. And I believe that this is the most important thing you can do, because every time you take a trade, you're full of adrenaline, you're full of anxiety, you're full of excitement. And if you take that picture, you take that trade, you work through it, but then you come back and you write on your chart, I had momentum or I did not. I had a clear path or I did not. This was my entry. This was my exit. What happens is it gives you something to study, but it also has you double checking your math, if you will. Maybe you thought you had momentum, but you really didn't. Or maybe you thought you had a clear path, but you really didn't. Maybe you jumped in way too soon or had enormous risk for that trade and you didn't realize it in the moment. Guys, I literally take 7 or 8 pictures, sometimes up to 10 pictures every time I take a trade. I take pictures before I get in to make sure that I'm following my rules. I take pictures when my rules aren't met to make sure I'm reinforcing my need to follow rules. I take pictures in the middle of the trade so that I can look at my management and make sure that it makes sense after the fact. And guys, when you post in the room, if you'll do me the favor of showing me your trades to completion, show me your entries all the way to your exit, guys. It's going to give us the most to talk about, and that's how I give you the best feedback. We're learning the looks so they become easy. This is the 101 tab. This is the tab where you should be taking pictures of the rules individually so that you can say, wow, this is what strong triggers look like. This is what my clear path is, and man, this is what my entry needs to look like each time I take it for the highest probability trend trade. I think it's equally as important to understand what it means when your advantage has gone away, guys, because that's your red flag that says, hey, pump the brakes. You have weak triggers, not strong triggers, or you have those termination conditions rather than a clear path. Go ahead and plan on filling this out. You'll get to where you want to be sooner. There's the client trades, guys, everything from entries to management to patterns that repeat themselves. And this can be kind of a template for your favorite looks. As you take all these pictures, start filling out this section. What does it look like to get you into the market? How are you going to manage it? What are these patterns that I keep seeing now that these trades have been easy? And what happens, guys, is the more pictures you take, the quicker you're going to get to where you want to be. I always encourage people, take at least 15 well-annotated pictures a day, guys. That's 300 pictures a month. That's a lot of pictures. It's hard to not get good at something if you put that level of effort into it. So this is our day. We're going to learn the trigger line and Fibonacci rules for when it's okay to trade. That's my job, is to teach you how to read these indicators. Your job will be to simulate, to practice, to win, to lose, to break even, and to understand that this is a learning process and there are no wrong answers when you're learning something. But you need to post them in the room so that I can tell you what you did wrong or right, and together we'll work to fix any problems that may be present, and we'll definitely celebrate the great things. We're going to keep it real simple. The more you look for as a brand new user, the more you find, and typically they're losers. Keep it very focused. Focus on these looks, these patterns in the beginning, and I promise you, you will break out of it and find more trades. So we're going to keep it focused, guys. 3 rules. That's it. 3 rules on 2 charts for the high probability trend trade. Rule number 1 says that the large chart, the big chart, the slow chart, the large crowd, guys, they must have strong triggers, because strong triggers will provide us the advantage of momentum. So if I open up my large chart and the background's green, the trend is up, I'm looking for rules to be met for high probability trend trades long. If the background is red, the trend is down. I'm looking for rules to be met for high probability trend trade short, guys. To have strong triggers in an uptrend, my small triggers will be green. My large triggers will be green, just like the background. And then my small triggers, the solid lines, will break up and above the large triggers. And the large triggers should be widening, angled in the direction of the trend. And that space that's created between the two lets me know that the odds are favorable for the market to continue up. You're going to hear odds favorable momentum in the room all day long, guys. You're going to see it annotated on charts, OFM. Odds favorable momentum pushes a market in the direction of the trend. Odds favorable momentum can break those key Fibonacci areas. Odds favorable momentum can cover some of the mistakes that new users tend to make. In a downtrend, when the background is red, both your small triggers and large triggers will be red. Small should be below the large should be widening, angled in the direction of the trend. It's the space created between small and large, it's that gap that lets me know that the odds are favorable for the market to continue down. Again, odds favorable momentum, guys. This is our advantage. This is your look, no matter what chart you're looking at. It can be the big chart, the little chart. It could be a range chart, a day chart, a month chart. It doesn't matter. Separation between the small and large means you have the advantage of momentum on that chart. When your small triggers work back inside of the large triggers, guys, this is a weakening. This is a visual representation that the trend is slowing. Anything can happen up or down with weak triggers. So we have odds favorable, anything can happen. When I have anything can happen, that's where the market is more likely to bounce. That's where retracements are more likely to happen. And guys, here's a large chart for crude oil. Weak triggers, and there's a big retracement. Strong triggers, and the market continues down. Weak triggers, big retracement. Weak triggers, big retracement. Weak triggers, big retracement. Strong triggers, and the market continues down. Strong triggers, and the market continues up, guys. So the one thing that you can do as a brand new user is commit to momentum. Commit to having rule number 1 met. And when it's met, you're going to make sure that you're not taking that momentum directly into a termination condition. But before we go to rule number 2, is everybody cool with rule number 1? Are you guys good? Separation means strength. When the smalls work back in, it means weakness. One is momentum, the other is weakness. That's rule number 1. When it's met, we're going to make sure there's no termination conditions, that there's no areas that may stop the market, that there's no areas where the large crowd may react and change direction, guys. And these are areas on the large chart. The large chart leads the way, and the large chart will define the areas and show you precisely where that large crowd is most likely to make decisions. The areas that we're using are just horizontal lines on the large chart, guys. They are divergence highs and lows. And divergence is a way of saying there was a loss of momentum in the move. So when the market goes up and down a couple bars, if there was a loss of momentum, you'll see a magenta line from a high. Or if it goes down and up a few bars and there's a loss of momentum, you'll see a cyan low from a low, guys. And these divergence lines are like lines in the sand where the large crowds may react later. There's Fibonacci resistance and support as well as yellow one-to-ones, guys. The recipe for identifying a termination condition is two parts. The first one is that price reaches the area. Price reaches resistance. Price reaches support. The market pushes to those key areas so that decisions can be made. Once price reaches an area, ask yourself, where are my trigger lines? Where are those T3 trigger lines? If they remain below resistance, resistance is a termination condition. It may stop the market. It may create an untradeable bounce, and it might even reverse the market completely. And if it does that, we're going to call it a strong top. And then price pushes all the way down to support, guys. And when you reach support, all you have to do is ask yourself, where are my triggers? And if the trigger lines remain above support, support may stop the market. It may create an untradeable bounce. It might reverse it completely. And if it does reverse it completely, well, we have a strong bottom. Guys, this is the look that's going to keep you out of a lot of trouble as a new user. These areas can stop the market. They can create bounces. They can take away your ability and all of your forward progress. Sorry, I somehow managed to crash Ninja Trader. It happens. Bringing it back up. Rule number 2 is the most broken rule. Rule number 2 is the reason most of the students in this room end up taking losses. Because rule number 2 lets you know without question precisely where things can go wrong. And it's up to you to make the decision on whether or not you're going to still try to trade it anyway. Rule number 2 became a rule because more often than not, you're going to lose trading into these areas, guys. That's no longer an advantage. So, areas do break. Momentum can break areas. The recipe for a broken area is that when the small triggers and the large triggers get below support, support's considered broken. It very often acts as resistance. If the small and the large get above resistance, resistance is now broken and behaves as support. Guys, once an area is broken, once the trigger lines push to the other side, both small and large, you have a clear path until you reach the next area. So for the brand new user, if you let it be one or the other, it's either a termination or it's a clear path. And guys, your termination condition may take, I don't know, an hour to clear. It may never clear. It might reverse. But from impact to fibs, where the triggers don't break, until small and large get below support, guys, this is your no-fly zone as a new user. This is your be patient, wait, let's see what the reaction is. And the same is true here. From the point of impact to resistance, when the triggers are below, you have almost 14 bars worth of patience. Good morning, Wayne. Until you have a clear path, until it's time to look for your rules to be met. One of the easiest things you can do, and I think one of the most advantageous things you can do, is open up your large chart and look at how support creates a bounce and it pulls right back to resistance. Hey Steve, good to see you. And how weak triggers, it resists, it goes right back to resistance. And when support breaks and the triggers weaken, it pulls right back to it as resistance. Perfect termination condition told you that the market had the potential to reverse. Support holds, resistance holds after support had broken. And guys, if you go back and you look at these over and over and over, you're going to be absolutely floored at how powerful Fibonacci can be. And hopefully you're going to develop a little trust and stop trading into these lines. The market moves, guys. You will find an opportunity. Is everybody good? Are you guys with me? If price reaches the area and the triggers don't break, let's sit on our hands. If small and large get through the area, the path is clear. Let's look for rules to be met. And guys, once you understand that very basic concept, and you can go through it in your head in a second or two, it opens the door for what's going to be your first medium probability trade. This is the second trade I will give you a plan for this trade, guys. And this trade is based on the premise that momentum has the potential to break areas. Your trigger lines are going to show you that potential, guys. When 50% of your trigger lines are through, meaning the small triggers have absolutely smashed through your area of support, but the large triggers are not through. They're still above support, guys. With odds favorable momentum, this fib has the potential to break. This is what we call the 50-50 trade. This is a medium probability trade. As much as rule number 2 is the biggest breaker of rules, guys, this is the most lost trade because it's only the potential, and taking an entry based on that potential is not high probability. It's what we call medium probability. These areas don't always break, and very often you'll see that they don't. I'm going to give you a plan to be able to take these with the highest chance of success. One of the things that bums you guys out is that there's going to be times when your path isn't clear because the areas are stacked a bit, and this is 90% of your day. 90% of your day is sitting on your hands waiting, being patient, telling yourself, man, my money is worth momentum. My money is worth a clear path. Guys, the futures markets trade trillions every day, and they average $220 billion an hour cash exchanged there. You have to collect 400 of that to become a 6-figure income earner as a day trader. 400, that's it. So when support is support is support, guys, it's okay. Do nothing. And what you're going to find is that Fibonacci gives you the ability to see precisely where the driving forces of the market are likely to make decisions, guys. And very often, rule number 2 will keep you out of consolidation. It'll keep you out of those choppy markets. And it becomes this giant red flag. Just don't do it. Give it a second. Let's wait. 90% of your day, guys, doing nothing. 10% of your day will be capitalizing on having momentum, having that clear path, and then ultimately looking for the entry area. I'm going to share one more termination condition with you. Sorry, gotta hydrate. Guys, if I go to look for my entry because of the first 2 rules being met, and I see 3 divergences in the same price range, this may terminate the trend. Remember, divergence is a loss of momentum. If I get 3 losses of momentum, 3 cyan lines from a low or 3 magenta lines from a high, this may terminate the trend, guys. This is a very powerful condition. When the 3rd divergence happens, and those small triggers are those anything can happen triggers, those weak triggers, makes it more powerful. Becomes more powerful still if the final pivot is higher than the previous from a low, lower than the previous from a high. Creates a little head and shoulders look, guys. This is the only time, the only look that will talk me out of entering a high probability trend trade when I have momentum and a clear path. 3 divergences on the small chart. But if they're not there, we're going to incorporate that smaller, faster refinement chart. You guys are going to pinpoint where the market is most likely to continue. You're going to pinpoint where that small crowd is most likely to fail. And you're going to do it by using a limit order to buy or sell a pullback at an area inside of favorable large triggers, guys. You're going to use a limit order to buy or sell the pullback, that little fight created by the small chart or the small crowd. And you're going to do it at an area, fibs, mid bands, yellow 1-to-1s, and those areas need to be inside of triggers. More importantly for the new user, favorable large triggers. Favorable large triggers are when the synthetic and the large are overlapping on your small chart. They're one on top of the other. They're 2 snakes riding piggyback. Because what happens is, and it's a mathematical thing, is price returns to large triggers. That's just how it works. Price returns to large triggers. It's going to return to the large triggers on your small chart. It's likely to return to the small triggers on your large chart. So your synthetic triggers are the large triggers, just superimposed on your small chart. So you're going to say to yourself, every time you're looking for an entry, small chart price may retrace back to the large. Large chart price may retrace back to the large, guys. So these triggers show you exactly where the retracement is most likely to go. We call that the correction point. The areas inside of the correction point, fibs, mid bands, yellow 1-to-1s, These are where the areas are most likely to, or where the market is most likely to bounce, where the small crowd is most likely to fail, where the market is most likely to continue with the direction of the trend. So you're going to be able to take this understanding that price returns to triggers, but it bounces off of areas, and you're going to create a window of opportunity that's going to allow you to get into trades, guys. And you know what? I think I'm going to take them off the spreadsheet today, just for fun. We'll do a long trade. So remember that a termination that reverses the market is what we call a strong bottom. And this is a no triggers through termination condition that reverses the market. Guys, this is the precursor to the highest probability trend trade you can take. Rule number 1 says odds favorable momentum, strong trigger lines. There it is right there. They are absolutely screaming in the direction of the trend. And then price has not reached the Fibonacci resistance. My path is clear. Guys, your entry going to the small chart has everything to do with the large chart telling you it's time. So now it's time to look for an entry. Guys, I'm going to start looking at my triggers. I'm going to start looking at areas and see where things are lining up. I'm not worried about one red line on a small chart because it takes a large chart to define my areas. So what I need to do is I need to wait for the small crowd to fight, guys. Everything says up and you're sitting on your hands and you're being very, very patient and you're almost a little worried the market's going without you. And then you get what we call a reversal bar. And a reversal bar, if all the bars are green and going up, well, that's your first down bar, red bar. Same way, if all of your bars are going down, a reversal bar will be a green bar up. At the time of the reversal bar, this is the signal of the pullback, the beginning of the fight from the small crowd. Your job is to first identify your trigger lines. From the top line of whatever trigger is highest to the bottom line of whatever trigger is lowest. This is why favorable large triggers pay dividends, guys, because the more they overlap, the smaller this box will be. This box represents where price is most likely to correct. It defines where I'll look for areas, where I will look for fibs, midbands, and yellow 1-to-1s. So once I define the triggers, I look for those areas and I create a window from the highest point of support to the lowest point of support inside of those favorable large triggers. Sometimes it's a tick wide, sometimes it's 10 ticks wide, guys, but this box, these areas of support inside of favorable large triggers, this is where the market is most likely to continue. Somewhere from the highest point to the lowest point is where my highest chance of success comes from. My job, because of the momentum on the large chart, because there's nothing in the way on the large chart, is I will right click on my small chart and I will activate a limit order, a tick or two above the highest point of support. And then I will wait, hope, wish, and pray that the small crowd gets there, guys, because there's nothing else I can do. The only thing that I will ever be in charge of is assuring that I have momentum, insisting on a clear path, and then using that little recipe to pinpoint precisely where the market is most likely to continue. And guys, this is your entry for the highest probability trend trade. This is the best of the best. And once you can pinpoint where the market's likely to continue, guys, you begin to understand that any lines on the wrong side of triggers, this is where the market shouldn't go. If this is going to be one of those 70 to 80%, it shouldn't come all the way down to this blue fib on the wrong side of the correction point, guys. This is not a part of the window. In a short trade, it's the same thing. You're waiting for the green reversal bar. You're identifying the triggers. You're looking for areas within fibs, midbands, and yellow 1-to-1s. One line inside of favorable large triggers, ladies and gentlemen, this is the point where the market is most likely to continue. Your order goes 2 ticks below it, and you wait and hope that the small crowd gets there. Any of these lines, fibs, midbands, yellow 1-to-1s, once they get to the wrong side of the triggers, once they're above the triggers in a short trade, guys, once they're below the triggers in a long trade, this is not a part of the equation. The market shouldn't go here if this is going to be a winner, guys. And your ability to pinpoint where the market is most likely to continue has you using that language. The market shouldn't go to the wrong side of those triggers. Your initial stop will be 4 to 5 ticks on the other side of those triggers. Above them for a short, below them for a long. Why? Because this is where the market should not go. Guys, it is insane to leave $300 and $400 stops on a trade when you have this level of precision. We can minimize our losses by understanding just this one trade. And the cool thing is, with all of those advantages, you're more likely to get a reversal bar in the direction of the trade, whether it be short or long. This is your first stop movement, and it'll be in the plan, and we'll outline it, we'll talk about it. But guys, you can go 2 ticks above that reversal bar because the market's telling you it's doing everything it's supposed to, or you can go 2 ticks below for a long trade. And guys, this is minimizing risk even more. And sometimes they're going to come get you, and you might lose $30 or $40 a contract rather than $300 to $400 because of the precision that rule number 3 gives you. Guys, this is my first hour. We talk about the best of the best for the first hour every day. We talk about the idea that when the large chart has momentum, when the large chart path is clear, your job is to learn how to pinpoint these areas inside of favorable large triggers so that you can enter the highest probability trend trade. Are there any questions about this, guys? This is your best look, either direction. It's not always going to be the look, guys. Favorable large triggers, one on top of the other, is always the best. It's the highest precision that we have. What's going to happen, and this is kind of the reality of trading, guys, is very often your correction points are going to be split from one another. Those large and synthetic triggers are not going to be one on top of the other. And every time you see this look, I want you to say out loud, price may return to the large triggers, price may return to the synthetic triggers. I have no idea which one it's going to be. And then you have to say to yourself, price could bounce off of a mid-band inside of that range. Price could bounce off of a fib down at the bottom of that range. The only thing that I'm sure of is that my stop has to go below the triggers where the market shouldn't go. I can define my risk before I ever enter the market, guys. This is a lot of indecision. Is everybody with me? This is where I want you to say to yourself, my entry is not perfect. My entry is not precise. My areas are not consolidated. I'm going to insist on one of those reversal bars. I'm going to insist on that confirmation bar because that confirmation bar establishes your risk 2 ticks below it. So if it bounces from the highest point, your stop's 2 ticks below it. You're in that long trade. If it comes all the way down to the lower point, you take a much smaller loss than keeping your stop below the triggers. So guys, confirmation bars when it's not perfect. You've got to learn these looks. Go back on your large chart. Circle a tail when the rules are met. I'm going to show you how to study right now. Let's just do that. Let's close this down. Let's go to a live market. I want you guys to see this. On my large chart, when I have odds favorable momentum and a clear path, I'm going to circle a tail. That's not a trade. I don't trade tails, guys. I trade pullbacks to areas inside of favorable large triggers. If I scroll back on my small chart, that market pulled directly to resistance right inside of favorable large triggers. Does everybody see it? That's your entry, ladies and gentlemen. Your order goes at 68.90, just below the lowest points of resistance. That market went $160. No, it went $190 worth of profit before 3 divergences pushed it the other direction. Kind of cool, right? This is what we're learning, guys. That's how you're going to study it. Go back and circle those tails. Build a little faith in the idea that momentum and a clear path creates the opportunity for winners, and that weak triggers right at a termination, well, that's financial suicide. Why on earth would you take this trade? Do you see how the smalls and large are red, but the background is green? When the colors don't match, I don't have momentum. Price reached a divergence low, but none of my triggers broke. I don't have a clear path. I don't even have areas inside of favorable large triggers, guys. Make the decision. I'm not going to trade if my rules aren't met. And guys, that's the first hour. I'm going to open up the S&P real quick, and I'm going to start giving you everything that I give out every day. Chart reading 101. To get to where you want to be, you got to learn the looks. That's it. You got to learn the looks. My job is to teach you the looks. Your job is to practice the looks and ask questions about what you don't know. The easiest way to get to where you want to be, guys, is snap a lot of pictures. 25 each. Strong triggers, weak triggers, clear path, termination. Take those pictures, drop them in the 101, and guys, don't just snap photos all willy-nilly. Talk about why is it strong triggers? Because the red background means that I'm in a downtrend, because the smalls are below the large, both wide in the direction, space between. This is strong triggers. This is odds favorable momentum. Rule number 1 is met. Guys, it's the same look, up or down. It's separation every time. Go take 25 pictures each, strong and weak. Do the same thing for terminations. Guys, give me a Y if you can hear me, please. Have I been talking to myself for an hour and a half? For an hour? Okay. Yeah. We'll see if she can do it. And yes, I have. Thanks, Ron. Make sure that you annotate Y's, guys. I think it's real important. It's one thing to see the pattern. It's another thing to associate that pattern with a rule or an advantage. And what I'm really hoping that each of you will do as you begin to learn this, as you begin to focus, as you try to put yourself in a good position, is my hope is that you get to the point to where you literally talk out loud. This is strong triggers. This is momentum. I've reached an area. I don't have a clear path. And when you start doing that, guys, your brain believes you. And if your brain associates certain looks with that truth, it becomes easier to wait for your rules to be met. So I'm going to give you that. I'm also going to give you the high probability trend trade checklist sheet, guys. And this shows you the strong top or bottom, termination, no triggers through, reverses the market. It shows you precisely what momentum is and what weakness is. It defines termination conditions, potential to break as well as broken. And it shows you exactly where to put your limit order, where the market is most likely to continue, what you wait for to get there, and where the market shouldn't go. This is, as you take those pictures, go through it, take a look. And then there's a high probability trend trade checklist on the second sheet here. This is what you're looking for to enter this trade, guys. Plain and simple. Is the market coming from a strong top or bottom? If it's not, it's okay. It's not mandatory. It just throws some warm fuzzies at it. Here's your rules. Odds favorable momentum. No termination conditions. Area inside of favorable large triggers. I would like you guys to be very specific when you're annotating charts, and use this language, because odds favorable makes you feel good about taking a trade. Anything can happen should deter you. Clear path should make you feel great about taking a trade. Termination conditions should defer you. And then, guys, this right here, inside of favorable large triggers, will keep you from taking the wrong trades from the wrong side of the triggers if you insist on that language. So print this one out. Write these on your chart. Police yourself every time you get into a trade. And you will get to the point to where you stop posting in the room saying, hey, Mark, was this a good one? You're going to say, hey, Mark, check this out. This was a good one. Notice how my rules are met. Look at my entry at the area inside of favorable large triggers. Don't be jealous, Mark. I did a little work, and that's why I'm so good at this. That's what's going to happen. And you're going to do it with the KISS plan initially. Guys, this KISS plan is a stepping stone in your learning journey. This KISS plan is designed to optimize your chances of success with the high probability trend trade. And then secondary, that medium probability 50-50 trade, you have a plan for both. If you're not comfortable with the high probability trend trade, you will suffer on the 50-50 trade a little bit. This is designed to give you the best case scenario. And then through simulation, study, class feedback, and continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Guys, once you can read your charts, once you can read your indicators, once you can talk about these advantages and find your entries, you're going to begin to see the patterns that present themselves. You're going to find the opportunity to make more money, to hold for bigger moves. You're going to be able to manage more assertively. But in the beginning, everything is super mechanical. All you're doing is defining your entry, guys. Never fight the large chart. Go with it. Define your entry. Why? Because great entries create manageable trades. Great entries put you in the market where the market is most likely to continue. Great entries help you define your risk. Guys, great entries is the first part of your management plan. And then your management, your actual management, once you're in the market, should be just as mechanical as your entries. Just as pragmatic, just as emotion-free. Because let's be honest, you brand new users, you're going to nail these entries and you're going to nail them fast with a little bit of study. But once you're in, guys, it is like pucker level DEFCON 5. Because now you have something to lose. Now you're afraid that they're going to take your money. Now you're starting to question that great entry, guys. So you've got to commit to it and you've got to learn to trust it. And then once you're in the market, for the whole time you're in the market, guys, from the second you enter the market, I want you to remind yourself that you're in because of momentum and a clear path on the large chart. So if the market pulls back to support inside of favorable large triggers, your initial stop is 5 ticks below the triggers, guys. 5 ticks where the market should not go. And even if it hits your stop, guys, it's not a huge loss. It's a very manageable loss. From impact to stop placement, there's nothing else for you to do. You're either going to get stopped out, and that's a normal part of a positive equity curve. Anything that wins 70 to 80% of the time has to get stopped out 20 to 30% of the time. Or you're going to get that confirmation bar, that reversal bar in the direction of the trade. If you get the reversal bar, then your new stop is 2 ticks below it. You've reduced your risk. Doesn't guarantee that the trade's going to win, but at least now if it doesn't, you'll lose even less. And you're going to sit on your hands and you're going to do absolutely nothing. And it's either going to stop you out or it's going to hit your first target. In the KISS plan, and guys, I've put it right here on all these pictures. All these pictures are in your spreadsheet. Your first contract is $100 away from your entry. Your first contract creates confidence. Your first contract getting to that target reduces the sweaty palms. And guys, the KISS plan is designed to optimize your chances of success. The KISS plan is designed to get you comfortable getting paid and to get you comfortable not arbitrarily moving stops and targets. Once you hit the first target, and that's not a very far distance, you're either going to get stopped out break even, totally cool, or it's going to hit your second target. And your second target is only $200 away from your entry, which means one trade, 3 advantages, perfect entry. Guys, that's a $300 winner. And a $300 winner is $75,000 a year. Let that sink in. Only $300 out of a market that trades trillions every day is $75,000 a year. Add a break even to it, you're in 6 figures. Guys, the goal of trading is to get paid. You'll learn how to hold for bigger moves. You'll learn how to hold for the next area using momentum and stuff. But in the very beginning, as a brand new user, keep it simple and basic. Keep it very mechanical. Focus on your entries, get a little management down, and then you will craft a plan tailored to your personal goals based on your experience reading the indicators. That's what the orange section is. Every time you take a trade, this is why it's so important to show it start from finish. Because there's going to be opportunities. And guys, if you take trades in the middle, or pictures in the middle, you're going to start saying clever stuff to yourself in the moment. This look on the large chart says give that last one a chance. Don't abandon the idea of getting paid and putting money in the account. But guys, on this trade, I've got everything to win and absolutely nothing to lose. And the large chart leads the way. And you'll get to the point to where you begin to manage like this. This classroom is designed to teach you to read indicators, guys. You're going to simulate and practice. Simulator is an outstanding platform for you to have no risk, for you to practice these things. And before you go live, there's two things that you have to know. You have to know why you'll enter and why you'll exit a trade. I can't stress this enough, guys. This is called a trading plan. And without a trading plan, you're more likely to fail. Your entries are rules. They're patterns that have been proven to win more than they lose. That's all they are. It's just a pattern. All it is the market doing the same darn thing over and over and over, and you found a way to capitalize. Your exit conditions, guys, are identifying when your advantage is gone, if the targets aren't reached. You have to be able to understand this is what it's going to take to get me out of the trade because I no longer have the edge, guys. And that's that same idea of the KISS plan stop placement. If it goes 5 ticks beyond those triggers, my advantage is gone. I want to exit the trade. So make sure that you understand why you're getting in. Make sure why you understand a plan to get out. And take the emotion out of your trading, guys. That's what rules do. When you have a pattern that's been proven to win more than it loses, you don't have to worry about what happens next, guys. It eliminates the need for all that emotion because you'll never be in control of anything other than making sure that those rules are met. So I told you I'd give you everything you need. So I put it into this zip file that says everything that you need, guys. And in this zip file is going to be the 101 checklist. In this zip file is going to be the high probability trend trade checklist. The KISS plan is in this file. My PowerPoint is in this file. Your daily goal sheet is in this file. Your exit conditions is in this file, guys. We have just gone through everything that you need to be successful. We've talked about the trigger lines and the Fibonacci rules for when it's okay to trade, broken them down individually, talked about the advantages, exactly what they look like, how to study them, where to go back and re-study them. Guys, you have access to the simulator, to the software, to NinjaTrader. You have everything you need to get good at these patterns. The only thing you need to do as you practice is to understand what you did right or wrong. I'm available 15 hours every week, live, to give you that feedback, to talk about what you're seeing and whether it needs an adjustment, to talk about your entries and whether you could have done it with less risk, to talk about your exits and whether there was the potential for more profit, or maybe you should have jumped ship sooner. Guys, a private session with every picture posted. You were given the spreadsheet, so you know exactly what it looks like, guys. That spreadsheet has been pre-filled out for you on a pretty colossal scale. Your job is to start filling it out yourself. Repetition creates recognition, guys. And I want you to see, not just a hair club member. If you go to my library, I'm at 6,642 pictures this year. What is today? Today is the 11th. Today I've already taken 18, I'm 20 pictures deep. Just today, 20 pictures deep, guys. Pictures are huge. They're such a vital part of what we do. The only thing that I haven't given you is experience. The only thing that I haven't provided was the repetition you need to be comfortable, guys. This is up to you. You now have the world's greatest hammer. But if you don't learn how to swing it, you're not going to be able to build anything. You're never going to pass building codes. So when we come into the second hour, guys, we're going to start looking at your pictures. The whole second hour is dedicated to you guys. Anything that you want to talk about, anything that you want to share, any questions that you have. The one thing that I ask is that you tell me what you see. There will be a point where you don't have to do this anymore because you've been in the room and I know that you know how to read your indicators, guys. But at that point, you're just showing off, which is cool. I want you to show off. But if you're brand new and you're working on this and you're not where you want to be and you're still getting comfortable and you're trying to get consistent, every chart you take a picture of, guys, talk about momentum, clear path, and entry. Talk about momentum, clear path, and entry. Whether it's there or not, talk about it. Repetition, repetition, repetition. Show me your trades from start to finish. Please, please, please. Every chart that I look at, I'm going to go back to these three things. No matter what kind of trade it is, Whether it's a high probability trend trade, a medium probability trade, whether it's a momentum trade, an HVA trade, whether it's that awesome white bar trade, guys. I'm going to go through momentum, path, and entry, and I'm going to put my 2 cents in. You don't have to take my 2 cents. That's up to you. Sometimes my 2 cents is going to chap your ass a little bit. You know what? Work through that. My job is to teach you to read indicators. My job is to give you feedback. My job is to not hold your hand and coddle your feelings, guys. Day trading is serious business. Take it seriously, please. I will see you in 5 minutes. I'm going to go stretch my legs and take a sip. Right now, I have weak triggers. Right now, I don't have any areas inside of favorable large triggers. I'm missing 2 out of 3 of my rules. I choose not to take an entry. I've got momentum, but I don't have a clear path. My triggers are split. The range is huge. The areas are floating in the middle. That's not my best look for a long if I'm following the KISS plan. So I'm going to choose to do nothing. I'm going to walk away, guys. When I come back, we're going to look at all your pictures and we will see where you're at. Post them if you got them. So I'm going to scroll up to the very top of the chat box and start clicking on the pictures that you guys have posted. I am not going to beat you up. If we are repeating the same lesson, I may say it firmly. But everything's going to revolve around momentum, clear path, and entry, guys. Everything is momentum, clear path, and entry. Rob has odds favorable momentum. Rob has a clear path. And Rob, you just jumped into the trade. I love this trade. I think it's really well executed. You've got that momentum. There's absolutely nothing in the way. And you're just saying, hey, you know what? Momentum is my reason for entry. I'm just going to jump in. And Rob, the only challenge that I see, and I think the biggest thing that you and I need to work on, are you still in here? Did he leave? Am I missing it? Well, hell. I can't find a good reason to have $150 worth of risk on this trade. That is from 45 to 39. Sorry, it's more than that. That's 6 points. Guys, if you're getting in because of momentum, a loss of momentum is an outstanding reason to take an exit. Have a reason for entries and exits. This would be one of those times where I say the stop makes absolutely no sense at all. Market goes up, still have now 7 points of risk as the market continues up. It does eventually turn, and there's the wonderful thing. Give every penny back, Rob. You gave every penny back plus some by not managing your momentum trade like a momentum trade. Guys, this is a great lesson, and thank you, Rob, for posting it in the room. If momentum is your only reason for an entry, loss of momentum is a good reason for an exit. Momentum for the entry, get paid. Momentum for the entry, loss of momentum should be an exit. So you add it on as it pulled back. I don't know what your entry is. It says 42.75. Rob, your entries are solid. Your management gives me heartburn. Nicely done. All right, Pete. Not odds favorable, but strong trend down. A little hiccup, and then it continued down. So, Pete, you learned your lesson on this one. Waited until a clear path on the big chart, and price got below fib on the small chart. Nice. Target was 1-to-1s. Reverse, got out first up bar, covered commissions, and avoided a much larger loss. Nicely done. Momentum in, loss of momentum out. It either goes or it doesn't. Great job, Pete. I think that's one of the things that you've got to be comfortable doing after a while. And I sure hope you guys can hear me. This is the most quiet class ever. Not every trade is going to win. Did you guys know that? Not every trade is going to win. Not every long will go the distance. Not every short is going to drop the bottom out. Not every trade is going to be a win. Be okay with that. All right, here we go. The Wayne Show. I love it when you guys post a bunch of pictures. All right, Wayne, let's talk about it. Odds favorable, 50-50, not a strong top. Wayne, a strong top would be a termination condition that reversed the market. You had a clear path to the upside, and the market just rolled. Still not a strong top. Strong tops are defined on the large chart, Wayne. You did have 3 divergences. You're absolutely right. Told you don't take any more longs, but it didn't necessarily. 3 divergences, it's not uncommon to see 3 divergences push you maybe down to the 1-to-1s with all of that look up for continuation up. It happens a lot. So I don't consider 3 divergences like a strong top. 3 divergences is just a, hey, don't go long. But I see what you did. You got in. Everything's down. And then you have your entry. I like it. You got stopped out. They just got you. And then when it goes back down, you re-enter and you're making some money. Nice trade. Good lesson on strong tops and bottoms there. Momentum is fading. Move stop to take profit. 330 on target 2. Total 430. Time in 12 minutes. Nicely done. Wayne, have you been in here for the idea that as long as it doesn't close on the wrong side of these triggers, it's going to continue? I love doing that one. I love using that. When I've got a runner and everything is screaming, I make them come get me. That was a beautiful trade though. All right, weak triggers with a pivot. Let me figure out which way you're going. You're going short directly into support, not from a termination. Every trigger line up. Entered below. Termination. All right. Second target set at midline. Midlines get bouncy when they are in the middle of nowhere. So do fibs when all the triggers are above them. I'm sure you're going to show us the rest of it, and it's just going to work beautifully for you. First target made. Buy stop even. Second target hit. There you go. Wayne, I'm not gonna tell you it was the wrong trade or an aggressive trade or anything like that. I want you to ask yourself though, just for the sake of longevity, I just want you to ask yourself, is that my best look for a short trade? Strong trending market to the upside with every indicator, every trigger line in an uptrend above the areas. And you let one divergence get you in a whole position. The other one, at least you had 3 divergences, right? Here you only had 2. And so I'm just saying, maybe not the highest chance of success, not the most likelihood of repeatable. Now we've got a strong bottom. Not enough momentum to enter the 50-50. I would disagree. And there's your momentum trade right there if you're going to take it. And it just flew all the way up. Termination, triggers roll. There's your white bar. You get in. I like it. Get paid at first trouble. Looking to see if it goes to the second one. Stopped out on the pullback for a total profit of 120. Nice job, Wayne. Gap with, we saw this one last week. Same one, downtrend, smalls below, 50-50, no momentum. You choose a white bar. I remember that one last week. Still doesn't make sense to me. And then that's the first one that you posted, so we got a lot of double posts in there. Good stuff, Wayne. Thank you for sharing those. Guys, remember, I don't have to agree with your trades. I just have to talk about what I see. All right, Tracy. High probability trend trade. Triggers not separated but trending up. All right. Tracy, are you with me? So if this is the recipe for a high probability trend trade, and Tracy, this is what I want you to take out of this. It takes momentum. Momentum is a result of strong triggers. Strong triggers is the separation between the small and the large. Does that make sense? That's rule number 1. So if there is no separation, It can't be a high probability trend trade. Does that make sense? And I do this because I think being very specific, especially as you learn the software, it really will. It's going to help you, because when you understand what you have or what you don't have, it makes it easier to make the decisions, I think. So your large chart, you did have a strong bottom. Right on, but so you're trending up. It's not weak, but it's not strong. And that's okay, we'll call it that. You had a clear path. So your momentum is somewhere in between the best and the worst, right? Rules say buy a pullback to an area inside of triggers. Well, you don't have momentum here. And there's your reversal bar. And you entered on the reversal bar, but do you notice that there's just no areas? There's nothing there. You're on the wrong side of everything. And your next area is way below on the wrong side of the triggers. So rule number 3, what you have is a loss of momentum. You have even less momentum. And you don't have rule number 3 met. And this is one of those ones where we just say to ourselves, son of a... I haven't been paid for the duration here. Let me go ahead and jump in. Not at an area inside of favorable large triggers. Does that make sense? Because I do believe 100% that the language that you use when you're looking for a trade is going to pay dividends. It's going to keep you out of a lot of losers. Divergence hadn't printed yet, but you're on the wrong side of the bounce point. There's no other bounce points. Then why didn't you enter at the 1-to-1s? Why did you enter 2 points below the 1-to-1s if you thought the 1-to-1s were going to hold? Now we're just going to throw logic into the equation. If the 1-to-1s were your hold spot, why would you enter so far below them? Clearly they're not going to hold. Does that make sense? These are the things that once you start to see the patterns, you're going to go through these little hiccups. And this is a normal part of it, Tracy, where you're like, oh, man, okay, now I see it. It wasn't perfect. Not quite. So Tracy, this is one of those times where you see that uptrend, right? And everything's moving up and life is pretty good, but your entry's not perfect. At least let it go in the direction of the trade, right? Get one of those up bars that says, hey, Tracy, we're at least going up with the clear path and that momentum. And what it does is it keeps you from just kind of hoping from the middle of the triggers. I love this chart. I like your large chart read. I think just that separation of the triggers, it would have been more likely to push. All right, weak top, absolutely. Possible strong bottom, 2 fibs mid-band, looking for smalls to cross up. Don't know what to call this dip to the mid-band with divergence. It's just a retracement. So the dip to the mid-band with divergence is just retracement. That's all it is. Your triggers got a little weak and it pushed lower. That's all. Nothing more. It doesn't fit into a plan anywhere. And I like that you call this a possible strong bottom, because I see it as an area with a potential to break or an area with a potential to hold. But I like that you said, I need the smalls to cross up. I need to see change rather than just arbitrarily going. If smalls on the 13-2 cross, there's a clear path. Well, potentially, yeah. I like it. It's a good read. You're anticipating what may come next. How did that turn out? That was the S&P at 735. Let's go see what the S&P did at 735. I'm not sure where yours was. We may have different time zones. Oh, that's crude oil. No wonder I can't find it. There was your weak top. Right on. Support smashed, right? And then we got the potential to break with a big retracement. And it just kept going down. I like it. And that's one of the reasons. Always play both sides of the coin, guys. You never know what's going to happen. So Tracy, you know, you say, hey, if this reverses, cool, let's look for longs. But don't forget that momentum and path is down. Like, don't weigh out the potential of a short if things keep pushing. And I think that's one of the cool things about futures is you can make it either direction, right? Like, you don't have to have a reversal to make money. And Ron, once it does break, Ron says, well, that's a pretty easy way to make cash down to the fib. I like it. Trig stack, base hits pay bills, guys. The momentum starts to clear, finds a way. Nice trade, Ron. All right, Wayne. Odds favorable, clear path. Didn't take the trend trade, chose to take it as a momentum style trade. Very nice. And then when momentum dies, you exit. Nice trade, Wayne. Momentum and clear path. Eventually, you're going to trust these lines. You had a divergence low like right at 34, and you got out at 35.6. 33, I guess, is where it went. So that's gold. I don't know enough about gold to understand how much those tend to hold. And then hit support. Everything says up. Trading into fibs based on large and small merge on large charts. Large trigger still down, more than a full bar away. White bar triggers rolled. You get in with a little room to make it. And lose a little on the second. Big bounce right off the termination once again. It says you lost a tick. Just a tick. No big deal. No big deal. But you see those weak triggers right into a divergence low? That causes a bounce. And I know you love this white bar trade. And it's paying dividends for you. Room to targets. I love room to targets. I'm weird though. I'm weird like that. And man, that's all the pictures, guys. That's it already. This is the S&P directly into a termination condition with weak triggers. That's great. I love it. My goal is that it's repeatable every day. My goal is that it's repeatable every day. That's the only thing I want for you guys, is that you rely on patterns that win more than they lose. Term reversed the market. No, it didn't, Andy. No, it didn't. You had odds favorable momentum in a downtrend. Does that make sense? It didn't reverse the market. It created, your termination condition created a bounce. But does that make sense? Okay. And you said, because I have a termination condition, because I'm on the correct side of the small triggers, I'll take a shot. And you did, and it was a beautiful shot. But don't convince yourself that this was a reversal. This is just a bounce. This is just a retracement. And your exit shows that you know that. But I'm going after the language because your exit is freaking perfect. I love it. Great job, Andy. I love this trade. I love the way you managed it. I love that you didn't hold on for home runs. You knew where trouble was. All right, Tracy. High probability trend trade. Room to the second target. Pull back to resistance right inside of triggers. I love it. Stop where the market shouldn't go. Manage stop once target hit. Break even when price hit 55. Move to 65. Hit second limit. Great job. Tracy, great trade. Great trade. Maybe a little big on the stop, 4 to 5 ticks, but I mean perfect, man. Everything was perfect. And you hit your first target and you went to break even. And did it hit your second target or did it hit your break even? Hit your second target, momentum and a clear path. And I think this is awesome, guys, because this is one of the things that I try to drive home every day. Once you have momentum and a clear path, you're just finding your way in. And trades become easier with momentum and a clear path. Stress levels go down with momentum and a clear path. Great, great, great trade. You know what, Tracy? Hold on. I feel like there's a lot of value in that one. I'm going to put it in the spreadsheet for other people to study. Guys, I do this. I steal pictures from you guys when they fit the rules, when they're done right. Immortalize you in the spreadsheet. Does the market just have a case of the Mondays? That termination condition's still holding, isn't it? We finally have the potential to break, but 3 divergences. Yeah, it is Veterans Day. Maybe all of our veteran futures traders are taking today off. Very possible. Three divergences in the same price range. Split triggers. Right on. I forgot about the market being affected. Moved pretty good this morning. Kurt, did you get some study done this weekend? Did you get the stuff I sent you? Make sure. You didn't get what I sent you? Or you just didn't get any study done? That's alright. Hopefully you're having fun. I'm starting to get worried that my stuff isn't going out. Because you're the second person to tell me that they didn't get what I got. And I just replied to your message. So I may have to check some stuff and make sure that I'm not broken. Well, guys, it is 10:22 a.m. We have gone through the rules, how to study them. We've gone through every picture that you've posted. What do you want to talk about? You got nut and run. All right, let me see if I can find a picture or two. Let's see if we can come up with some lessons here, guys. You know what? I'm going to do this. I did little funding blogs. One of the things for you guys that are using reversal bars for confirmation, there's something on buy and stop orders. That's a good one. You guys want to see how easy it can be? Define your termination condition. If the triggers roll, look for a short. And then if everything is strong, look for a trend trade. Rinse and repeat until you get to the next termination condition. There's the plan. Let the triggers roll. All right, we're going to double up on breaks today, I guess. So, guys, I'll be back in 5 minutes. If something happens or you have a question, post it. Back in a minute.